fair value gap. It's one of the hottest concepts in trading right now, and there's a good reason for that. When used correctly, fair value gaps can be incredibly effective, but here's the thing, not every fair value gap is the same. For example, this fair value gap completely failed, while this one played exactly as expected. So what made this fair value gap succeed while the other didn't? The answer comes down to a simple technique I use that lets me instantly identify whether a fair value gap is actually valid or not. Once you start applying it, you'll notice your fair value gap setups become far more reliable. Before we get into that, let's first understand what a fair value gap really is. There are two types of fair value gaps, a bullish and bearish. A fair value gap forms whenever price explodes aggressively in one direction, creating a large impulsive candle. Take this example. Price rallied with so much momentum that it printed this massive bullish candle. Because the move happened so quickly, sellers didn't have enough time to push back against the buying pressure. That creates what's known as a market imbalance. Eventually, sellers naturally want to revisit that area. To mark a fair value gap, simply draw from the upper wick of the candle before the impulsive move to the lower wick of the candle after it. That area becomes your fair value gap. If you scan through almost any chart, you'll notice these fair value gaps appearing everywhere. In many cases, price returns to the gap, fills the imbalance, and then continues moving back toward the previous high. And that's exactly where the opportunity comes from. However, if you've traded fair value gaps before, you've probably noticed that they don't always hold. That's because the fair value gap itself wasn't valid. So what makes a fair value gap valid? There are 6 important conditions that should be met before considering any fair value gap a high quality setup. The first condition is that the fair value gap must remain unmitigated. The entire idea behind a fair value gap is that price moved so aggressively the opposing side never had a chance to participate. That zone should remain untouched if it's going to stay valid. In this example, right after the fair value gap formed, price immediately retraced into it before continuing higher. Because the gap was already tested here, we would have no longer treated it as valid fair value gap if price returned again. Because the fair value gap was already tested here, we would no longer treat it as a valid fair value gap if price returned again. For a fair value gap to stay valid, it needs to remain completely unmitigated. Once it's already been tested, we consider that fair value gap invalid and avoid using it as a setup. Now let's move on to factor number 2. The second way to judge whether a fair value gap is valid is by looking at how the reaction candle closes inside the gap. Ideally, you want the candle to close within the fair value gap or finish in the direction of the expected move. In this example, price traded straight through the fair value gap and that candle eventually closed below it. When that happens, the fair value gap becomes invalid. Instead, what we want to see is a reaction like this, where price closes back inside the fair value gap, giving us a much safer setup. It's completely fine if the wick pushes beyond the fair value gap, as long as the candle itself closes back inside the zone. Now let's move on to the third factor behind a strong fair value gap. One of the easiest ways to improve the quality of any fair value gap is by adding extra confluences. A great example is support and resistance. On this chart, price creates an unmitigated bullish fair value gap, but if we look a little closer, we can also see an existing support level sitting right there. Notice how the support lines up almost perfectly with the fair value gap. That's a powerful confluence, and it's significantly increases the probability of the fair value gap to hold. The exact same idea applies to bearish fair value gaps. You want to find a previous resistance level that aligns with the fair value gap. Whenever these two line up together, the fair value gap becomes much stronger. Now let's talk about number 4. As I mentioned earlier, not every fair value gap carries the same importance. Some simply are more important than others. An easy way to rank them is by looking at where they sit within the overall move. On this chart, we have several bullish fair value gaps. The lowest bullish fair value gap will usually be the strongest and deserves the highest priority. The highest bullish fair value gap, on the other hand, is generally the weakest and should have the lowest priority. In an ideal situation, you should always look to trade the lowest bullish fair value gap available. The same concept works in reverse for bearish fair value gaps. If multiple bearish gaps appear on the chart, the highest one should receive the most attention. Following this simple rule will greatly improve your chances of choosing the fair value gap that's most likely to work. Now let's move on to the factor number 5. This factor builds directly on the previous one by helping you identify the highest priority fair value gap. Open TradingView and select the Fibonacci tool. Then go into the settings and make sure the price levels are set to 0, 0.5 and 1. Now your chart should look something like this. Whenever multiple fair value gaps appear during a move, draw the Fibonacci tool from the swing low to the swing high, and this will give you a quick visual guide for deciding which fair value gaps deserve your attention. Ideally, you should avoid trading fair value gaps that sit in the upper half of the range. Instead, focus only on the fair value gaps looking located in the lower half. For bearish setups, simply reverse the process. Draw the Fibonacci tool from the swing high to the swing low and then focus only on the fair value gaps located in the upper half of the range. By following this rule, you'll consistently be selecting the highest priority fair value gaps available. Now let's move on to the sixth and final factor. Now the sixth and the final factor is the break of structure. Before trading any fair value gaps, you should always see a break of structure happen first. A break of structure simply means price breaks above a previous high or a previous low. In this example, price formed a fair value gap, but it never broke the previous high. Because of that, there was no break of structure, so this fair value gap isn't the one we'd wanna trade. Instead, we are looking for something like this. For a bullish fair value gap, price should always first break above the previous high. During that move, it will often create a fair value gap. Once that happens, the gap becomes valid because it formed after a break of structure. The exact same principle applies to bearish trades. Price should first break below the previous low before creating the fair value gap. Once you combine all of these 6 factors together, you'll have the highest quality fair value gap setups, and that dramatically increases the odds of price respecting the zone and giving you a profitable trade. Let's walk through a live example. The first thing we notice is that price created this previous high, and this is the level we use for our break of structure. Next, we simply wait for price to trade above the high and confirm the break of structure. After that, we wait for a fair value gap to form. Then we check that the fair value gap is still unmitigated and hasn't been tested before. In this example, everything still looks good. Next, we identify which fair value gaps have the highest priority and which ones have the lowest. That makes it much easier to decide which gaps are actually worth trading. After that, we grab the Fibonacci tool and draw it from the swing low to the swing high. As you can see, these fair value gaps sit in the upper half of the range. Because of that, we can remove them from our chart since it doesn't meet our criteria. That leaves us with this fair value gap instead. And if we also take a closer look, we can also see a support level lining up perfectly inside the fair value gap. At this point, the setup looks excellent because it satisfies every requirement of a valid fair value gap. Now all we have to do is wait for price to retrace back into the zone, and once price reaches the fair value gap, we want the reaction candle to close either inside the gap or above it. That's exactly what happened in this example, showing us the price is respecting the zone. And just as expected, price exploded higher after tapping into the fair value gap, and it rewarded us with a clean winning trade. Start combining all 6 of these factors together and you'll quickly notice your fair value gap setups becoming much more consistent. Notice how the third candle closes above the high of the second candle. When that happens, the fair value gap becomes what's known as a breakaway gap. A breakaway gap usually tells us that the buyers are still in complete control. Instead of pulling back and retracing into the fair value gap, price will often continue moving higher without ever giving us an entry. Now compare that to this example. Here the third candle closes below the high of the second candle, creating a rejection or a consolidation candle. This is exactly the type of fair value gap we want to trade. That small pause in momentum often signals that price is much more likely to retrace into the fair value gap before continuing in the original direction. And as you can see in this winning example, price returned to the fair value gap, respected the zone perfectly, and then continued higher exactly as expected. Hopefully you found this video helpful. I'll see you in the next one.